Today we are discussing First Republic Bank, ticker FRC. Over the next few minutes, I'll discuss my thoughts about the business quality and its valuation. So first up, this company has a market cap of $24 billion, enterprise value of $26 billion. See about $1.5 billion in net debt on this business. Not a significant amount, even considering it is in the banking industry. So they provide private banking, private business banking, and private wealth management services to clients in the metropolitan United States. I want to focus on this because private banking tends to be a higher quality bank part of the banking industry than just normal residential banking or consumer banking. Private banking tends to have slightly better returns. You see they have two segments, commercial banking and wealth management. Wealth management is a nice part of the banking industry because you can get some fee income to supplement your net interest income. It's a good way to boost your return on equity, return on assets, that sort of thing. So bank accepts deposit products, non-interest bearing checking, interest-bearing checking, money market savings, passive accounts, etc. So they have single-family residences, multifamily building, commercial real estate. Provides wealth management services, which includes various things like online investment management, trust and custody, full service and online brokerage, etc., etc. Okay. So you can see they have 82 deposit-taking offices across a bunch of the United States and 12 additional offices that offer lending, wealth management, and trust services. So good information here. Headquartered in California, gives you a good overview of what they're doing. Again, tends to be in a slightly better part of the banking industry than your average bank. Now let's go down to the return on equity here to get a good idea of how they're doing. Now, what you can see is that from year to year, besides 2008, 2009, this 2010 time frame, the company had extremely good returns. 2010 is at 0% for looks like 20 straight years with no losses. And they didn't tend to experience losses, it looks like, in the global financial crisis. However, I am noticing that they are missing data for 2007 and 2008, so it could be a discrepancy here. One of the things I would do before buying this company is I would want to dive deeper into what happened in 2007, 2008. That's going to tell me a little bit about their risk management philosophy and that sort of thing, which is very important for a bank. You see returns on equity in the early 2000s, 9%, 8%, very, very, very stable. That stability is a sign of a high quality business. The return on equity is also a really good number here, right around 10%. The returns seem a little bit better in 2011 and in this decade. You start at 14% here, 13, 12, 10, but they trend back down towards 10%. What's interesting is they're maintaining a 10% return on equity despite the very low interest rates that we have seen since the global financial crisis. This has been a very hard decade for banks. So the fact that you can still earn a 10% return on equity during this hard decade is a good sign. You would like to see that number higher, 12, 15, up to 20% if you could, even though with a bank that would be very, very difficult. You just have to remember this has been a very hard decade. But that stability is very key, very predictable numbers. I like what I see there. 10-year median returns, of course, match up with that. Return on assets of 1%, return on equity of 10.5%. What this tells you is that they have normal leverage. It's not abnormally high, not abnormally low. A 10 times leverage for a bank is pretty standard in the current day and age. 10-year CAGR gets where it gets very, very interesting. They're growing their net interest income at 14.5% per year, gross loans at 20% a year, earning assets at 20% a year, deposits 21% a year. These are very important. You need to grow your assets and your deposits at least as fast as you do your net interest income to be sustainable over the long term. What this is telling us is that they're growing their deposits and earning assets at a sustainable rate for the future because their loans and net interest income are not growing faster than that. So very good sign here for their overall CAGRs. But even in addition to that, you're growing at a rate that allows for very, very high compounding for you as a shareholder. If you're able to grow at 15 to 20% a year, that's a very strong setup. Now, I have a little bit of a concern because they're growing faster than the return on equity. Usually that's going to require either additional leverage, additional risk, something along those lines. So we're going to have to dive a little deeper into that, see what's going on and how they're managing that risk. But we can do that in the later parts of this video. For now, what I see here is all very good. High quality business with high growth. That's a very strong setup for shareholders to make a lot of money. Now, then we go to valuation, and they're at a PE of 14.7, which is very important because I really like to buy stocks with a PE of 15 or less. That allows me to always ensure that I'm paying less than the average price for a stock. And so if I can combine that with a high quality business, if I can combine that with high growth, I have a very strong setup for good returns. So a PE of 15 here is a reasonable price, seems like a reasonable valuation for a business like this. Could actually be substantially undervalued when you take into account that they're growing faster than their PE ratio. 15 to 20% growth rates are very, very good. Strong setup here as well. Again, their future returns might be even better because this has been a particularly bad decade for banking. And so when you look over the last 10 years, you can keep that in the back of your mind. Now let's go look at a little bit more details here. You see this earnings per share, $2.75, growing to $7.68 over the last decade. Of course, more than doubling in a decade. Very strong setup. It makes sense why you would see that based upon what we're seeing here. They're doing that growth while paying out a dividend. Now, the dividend payout ratio is pretty low. You're seeing 10 to 15% is what their payout ratio here is. Pretty reasonable for a bank that is growing very quickly. You would actually prefer as a shareholder to get a lot of growth instead of a lot of dividends. So that's a good thing when you're able to achieve it in a sustainable manner. So I like what I see there as well. They're running a very high loans to deposit ratio. That might be why they're able to grow at this fast rate, is they are really leveraging up that balance sheet with high loans. Good to know there as well. They also have a pretty low loans to reserve loss ratio. So for whatever reason, they think that they're going to have relatively low losses. That's another important thing to understand when you're analyzing this bank, is if they do have higher losses, that could be a risk. But for the most part, they're estimating a relatively low number of 0.5% of what their loan loss reserve setup is. Overall, first impressions are very good. Looks like a high-quality bank at a reasonable valuation, growing very, very quickly. Could be extremely attractive. The caveat is, of course, the faster you grow as a bank, the more risk you might be taking. So you're going to have to take that into account as a potential shareholder. But next up, we're going to go to the income statement, balance sheet, and cash flow statement. And if you're enjoying this video, please hit that like button. And I'm going to work on providing a lot of value over the next few minutes so that you can consider subscribing at the end of this video. So we can see the net interest income here is very, very high. You can see the big gap between interest income and income expense. Part of that, of course, is that the Federal Funds Reserve rate has been very, very low. You see it start to climb in 2018 and 2019 as the Fed raised interest rates, and then it dropped again in 2020 and 2021 as the Fed lowered interest rates. Now, they've raised it again in the most recent years, so you're going to see this interest expense start to climb again. But of course, their interest income is the key point here, staying well above that. Your very high, basically gross margins is one way to think about this net interest income compared to the overall money that they're bringing into the business. Now, one of the things that's nice about operating in this sort of segment is you can get some really robust non-interest revenue. That's that private banking segment. And of course, their non-interest revenue is not exceeding their non-interest expense. That's not the goal. But the key point here is when you have like non-interest revenue exceeding something like your interest expense, it's a very good way to boost the bottom line returns of the business because you're able to offset some of your overhead cost with that income. If this business had to operate without any non-interest revenue, it would be a worse business. You would see worse returns. So that is what you're seeing here. Now, a key caveat is when we go back to this overview statement, we see that they had return on equity of 10.5%, but they're growing in the 15 to 20% range. How do you do that? The standard way you do that is you have to take on debt and you have to dilute shareholders. Well, banks are kind of limited in their leverage, so it ends up being diluting shareholders is how you pull it off. And that is what you see. You started with 134 million shares outstanding. You ended with 180 million shares outstanding. So that's about a 40% dilution rate, 30 to 40% dilution rate over the course of a decade. That lowers your per share compounding by 3 to 4%. However, a 3 to 4% reduction when your compounding growth is 14 to 21% is okay because you're still ending up with high, double-digit returns, mid-teens, low teens, high teens. When your range of potential outcome is a low to mid-teens return, that's a really good outcome. So I'm okay with some dilution when you're actually getting very strong returns like that. Now, ideally, your return on equity would be high enough that you could achieve that growth without any dilution. And it's possible that they could do this over time as they increase operating leverage. If they can get this non-interest revenue up, then maybe they don't have to dilute as much over time. That would be something you'd want to be looking for, see if you could pull that off. But you clearly do have some dilution here that's been a hamper on the business. But when you compare it to your overall growth, you think about this, is you're almost tripling your income over the course of a decade. That's still a very good sign. And so to do that on a per share basis means that your dilution hasn't hurt you enough to be a problem. And so I'm okay with that. But it's an important caveat. That's how they're achieving that high growth. They are providing some dilution into the business model. Now, balance sheet. With any bank, you're going to want to dive into the FDIC call reports. This can only give you so much, but you want to look at stuff like deposits. So you've grown your deposits rapidly from 22 million, or is that 22 billion? How was it? Yeah, 22 billion to 156 billion. So you're growing very, very rapidly. Yes. Yeah, 22 billion to 156 billion. They're growing very, very rapidly. I think those numbers are off. Millions, 459 million, 2 billion. Yeah, that's right. So they're growing very rapidly. You have 7x your deposits, and that's allowed you to really increase your net loans. And you can see these deposits are what you'd call your earnings assets. You're using your deposits to issue loans. That's how the banking business model works. And you can see, of course, this low loan loss reserve. So even though you have a very high amount of loans, they don't think there's going to be a lot of potential losses here. And so that's really the caveat here. Now, one thing to think about this is a very high amount of assets at this point. And so you need to be aware that, can you repeat a 7x growth in deposits again? It would be hard. You're going to have to start stealing a lot of market shares. So I would expect growth to slow down a bit, of course, but that would mean that you wouldn't have to dilute as much. So it's going to be a little, trade-off over time there. An important thing to remember with banking, of course, they require very few PP&E. It's all the assets are really all about money. You're trading money, buying money, selling money. That's all that interest rates are. So nothing to see there from that side. Another thing that you can see on this balance sheet is they're funding, if you look at this ratio between securities and loans, they're heavily funded on the loan side, and that's actually good because loans tend to have a higher yield than securities, so it's a good setup for you as a shareholder if they're able to make a lot of good loans. Okay, so you have stock-based compensation. This is one of the reasons for dilution. And then, of course, you have additional net issuance of common stock as they're trying to fund the business. So that's one of the ways they're bringing in the cash in order to operate the business. It looks like they're also issuing some preferred stock, and they're issuing debt to continue to keep the business growing at this rapid rate. Now, as long as they have returns like they did over the past decade, totally fine. This actually is really good for shareholders if they can pull that off. The big question is that is an if, it's not a guarantee. In fact, I'd rather them just not pay dividends and potentially dilute you a little bit less. That would be how I would prefer to run the business. Don't be paying that dividend if you're required to be diluting in order to grow. I'd rather you just not pay the dividend, dilute a little less. That could actually end up with a better return overall and just a little bit more respect for shareholders on the shares that they have. However, this is a very strong setup. It would be something I would consider as a potential investor in banks. I really like the banking industry. I think it's a very strong business because when you see, it's hard to see the stability that you have in banking. Year-to-year returns like this are amazing. Now, the big caveat here is I would need, before I add it to my watch list, I'd really need to understand 2007 and 2008. They're not shown on this chart. I don't know the reason for that. But it is a hole in my data. You can see from here 2006 to 2009, we're skipping those 2 years, and those are very important. If they have massive losses during the financial crisis, that would be a concern for me. That would be a stopper. So before I would consider adding it to my watch list, I want to do a deeper dive on their history. But overall, some very exciting things with this company. I really like the private banking part of the industry. I like that you can bring in those what is it? Let's see. Let's go back to the income statement. So the non-interest revenue. So that's really important because basic banking is interest income minus interest expense. But when you get into stuff like non-interest revenue, that can really boost the return on equity of a business. So I like when I see that. Those are the types of banks that get me really interested. So First Republic has some really good signs here as a potential investment. I hope you learned some stuff from this video. I think there's some great parts of this business that are worth checking out, worth learning about. So if you enjoyed this video, if you learned something, hit that like button. Please subscribe. Your subscriptions help me to grow the channel. Let YouTube know you're enjoying the content. And if you think about subscribing, you want to learn a little bit more first, Also, check out the playlist at the top. These are my watch list stocks. These are my favorite companies in this S&P 500, the ones that have made through all of my hurdles. And so I think you're really going to enjoy those videos as I dive through the very best companies in the S&P 500. That's worth checking out. And if you want to use software like this to study a company in 5-10 minutes or less, quickfs.net, my affiliate link is the first link in the show notes below. And I hope you'll check that link out as well. Thank you for listening. And until next time, stop paying fees, start building wealth.